Yeah, so so for everybody in the recording, I'm talking about entry points today and entry patterns so that you guys can get entries on lower time frames a lot easier. Okay. So this is our small list for now. These are the ones that you're gonna come up that are gonna come up a lot more frequently. Okay. And the reason why I want to show these to you guys is because these are something that a lot of you guys have had a lot of trouble with. And I felt like a class on them would be beneficial to all of you. So okay. Now remember, entry patterns are nothing without analysis previously. So for every single pattern that you see here, this is like, let's say you're on lower time frames and you want to find an entry. This is what you're going to look for, right? But before you even get to this point, what do you need to do?
To recognize the order flow, sir, first.
Okay. What should you be doing on higher time frames?
Liquidity and target.
Right. So you should be analyzing where your target is, right? Where your liquidity is. You should be doing analysis on higher time frames before you do anything else, right? Before you do anything, you should be looking at higher time frames and doing your analysis there. And then from there, your lower time frames will be, will be where you're looking for this. Okay. So even before you look at entry patterns, you should have already been looking at your analysis on lower time frames. All right. So hold on just 1 second. Let me see if I can take this off. All right. So now what we're going to look at first is the mitigation block. Okay. That's the first thing we're going to look at. The first thing that we're going to focus on is the mitigation block. Now, the mitigation block is quite easy. Okay. And we'll actually move it down here and we'll put mitigation block. Okay. It's quite easy. A lot of people have trouble with the mitigation block because they confuse it for a breaker. It's not the same thing. It's very similar, but it's not the same thing. So a mitigation block first. So the first thing about a structure with a mitigation block is there has to be a certain structure, right? In this case, we're going to put it on a bullish perspective, but if you want to flip it over, that's the bearish perspective, okay? So let's say price has, let's say there is a point of liquidity right here, right? This is a previous low. Price has taken this liquidity, right? So this is a point of liquidity, and now price has traded beneath into it, right? So now price has traded beneath into this point, and now price has taken liquidity. So at this point, right, price has taken liquidity. There's no liquidity here left, meaning now price has to seek a buy side target. So let's assume price has a buy side target all the way up here. And let's actually put this as okay. So now if price is going to head up here now, right, this is what you want to do. You're looking for a buy side target, right? You're looking for a buy side point. So now what you're going to do is you're going to do this. You're going to wait for price to start making its break forward, right? It's break upward. Now let's say that price comes up to this point, and now price has essentially done this. Okay. You see that there's something right here that's slightly different than a breaker block. What's the difference? What's the difference between this and a breaker block?
The breakout typically take the buy side liquidity and it's a failure zone.
It's a
Oh.
trend line liquidity.
Okay, so essentially what the difference between both of these, right? What's gonna happen is the difference is that a breaker has broken structure and taken liquidity on the other side. A mitigation block has not. A mitigation simply mitigates the move that created the break of structure, right? Which is right here. So this right here, so this move has mitigated this past move, right? And now price has gone upward. So now price.
Brother, I didn't understand. Please, can you explain me?
Okay. Hold on. Okay, so a mitigation block, all that it is, if we remember the definition of mitigation, mitigation is simply when something retraces deeply into its previous structure, right? And it essentially on higher time frames, mitigation closes out losing orders, right? That's a very simple explanation. So a mitigation block, what ends up happening here is a mitigation block goes up, comes back down, it mitigates this order, right? Basically, it retraces deeply into this order, but it does not do this. Okay, it doesn't do that. It doesn't break structure. It stays within structure, essentially creating a form of trendline liquidity, right? But this liquidity will never be tapped. What will end up happening is price will return to this point, okay? And then it'll go higher. All right, and then price will reach its target. So the point that we want to actually look at is this right here. This is the points that we want to look at, okay? This here is your mitigation block, okay? This is your mitigation block. Your important entry point is going to be the tip right here, the point that started the mitigation. Sometimes in these cases specifically, what ends up happening is price likes to test a little bit lower, especially on lower time frames, because remember, this whole study is meant for lower time frames, not for higher ones. So this right here is going to be your point of interest. So your entry is going to be right here. Right here. So we'll actually push it down. Like this. Okay. Remember, since this is supposed to be on the 1 minute or on the 3 minute or on the 5 minute, your stop loss should already be quite slow. Oh, sorry, quite low, right? Your stop loss should already be quite small. So what's going to end up happening is you can put your stop loss here at the bottom. You can also put your stop loss here, or you can trade it, you know, how a mitigation block is supposed to be traded, which means like your stop loss beneath the candle, similar to, you know, how you would trade a breaker block. For me, I like to put it at structure, especially on the 1 minute and on smaller time frames, simply because it gives the pair more spread. It gives it, you know, space to breathe, especially because you know, different brokers have different spreads. So because of those spreads, it becomes very difficult for certain brokers to get you into the order, or, you know, sometimes it'll stop you out when you're still like a pip away from your stop loss on your chart, whatever the case may be. I like to give my stop loss a little bit more space to breathe. So I generally put it around this point of the mitigation. You can also put it below just to make, you know, just to be safer. But I like to put it you know, maybe somewhere in the middle. So anywhere you'd like, that's, you know, beneath this point is going to be good for a stop loss. Okay. And now your target, obviously your target is going to be wherever you had already determined your target to be. In this case, we had a previous high, or whatever the case may be, where price is going to head toward. Okay. Does this make sense for a breaker block? Oh, sorry, a mitigation block.
Yeah, you are targeting, you know, the premium level from the discount.
Right. Yeah. Mhm. So does this make sense?
Yeah.
Okay. Now the one that's going to be one second.
And sir, how this mitigation block trick the retailers?
Sorry. Can you repeat that?
How this mitigation block trick the retailers? Matlab, how it traps them in the opposite direction or not?
Well, this is supposed to be a pattern that we see on the 1 minute, right? Of 1 minute, 3, 5. So this is for lower time frame entries. So this whole class, what it's focusing on is lower time frame entries, right? And the lower time frame entries, what ends up happening is these patterns will show up very quickly, and you have to learn how to adapt to these patterns extremely quickly. But it's something that you'll learn later on. So a lot, not later on, you're learning it right now. But what I'm saying is this isn't something that you're going to think about and say like, oh, how it's tricking other people. This is just patterns that you can get better entries on. Yeah, so you're supposed to enter after the mitigation has happened. This is the mitigation happening right here. Price comes up, and now price comes back to take this point, right? That's the pattern that usually happens. And you'll take your entry right at the tip of this, and not nowhere beneath. You'll put it right here, if that makes sense.
Yeah, it's kind of like securing or being safe in the entry. Otherwise, we could have taken the entry like where the mitigation ended, seeing an order block or something like that. But this way is more secure to get an entry.
Yeah, so this is a pretty secure way to get an entry. It's a pretty easy way to get an entry. The one that's going to be this one's not very common. The one that's going to be a lot more common is going to be the breaking block, the breaker block, right? That's the one that's going to be a lot more common for you to find entries on. Okay, so this is a slight variation of the breaker block. The only difference between a mitigation block and a breaker block is the fact that price, only takes this point like this. So, the one that I'm going to show for the breaker block is going to be slightly different, but the entry that you'll see is going to be pretty easy for you to pick up on. I also believe there was an entry on it for AUD USD. Yeah, so it's over here. Right, so this is essentially a breaker block, and I'll show this. I've shown this in class before, but I'll show it again. Okay, I'll move this over there. Now we're going to talk about the breaker block, okay? Does everybody understand this, by the way? Does everybody understand this? Does everybody get this?
Yes,
Yes.
sir.
All right. So now we're going to talk about the breaker block. The breaker block is quite simple. And I'm sorry if my explanation for the mitigation block was slightly kind of out of tune. I was slightly distracted because somebody needed my help with something, but now it's full focus. So we will focus completely on the breaker block. All right, so the breaker block is very simple. Similar to what we just said, we're going to put the same example, right? Let's actually do this from a bullish perspective, so from a bearish perspective. That way people kind of get the idea of both. So let's say price has a point of liquidity at this point right here. And price wants to take it. right? Price takes it, makes a retracement, goes higher, and then comes up, goes below, right? Break structure. And now price has created its pattern, and now we'll reach the point of structure that we wanted it to, which, like, let's say price had a target for liquidity right here. Okay, and it's reached its target. So what we're looking at is this right here. Okay, this is what we're looking at right there. That's what we're looking at. Okay, the first thing that's going to happen, right, is the fact that price in this case reached the point of liquidity, retraced, went higher, right? It broke structure more, which means that it's going higher into premium, right? To get a higher entry for a lower order. Because think about it. If you wanted, if you could control price and you knew that price would go to this point, would you take an entry here? Oh, let's put a little flag. Would you take an entry here, or would you take an entry here? At which one of the flags would you take it? Would you take it at the lower flag or at the higher flag?
Lower.
Higher flag.
The higher flag, right? You'd
The
obviously
higher
take.
flag,
You'd obviously
Uh-huh.
take the higher flag. Why? Because, you know, it's very simple. You think, okay, well, I really, you know, I want to get more money. So if I want to get more money, I'm gonna take the higher flag, right?
moreover, it could be a turtle soup.
Right, but we're not talking about turtle soup right now. So you want to take it from the higher point, right? Because you're, you know, you want to get more money. This is, of course, hypothetically, if you could control the market, which we cannot. So that being said, what we're waiting for here is if price wants to push price higher, or if, you know, the algorithm wants to push price higher, from a theoretical standpoint, you would say that the point where orders are most heavy in terms of buy orders to push higher is going to be around this area. So in that case, we mark this area off, specifically the top, right? We mark this area off as our point of entry. So this is going to be your point of entry, okay? This point right here, and I'll mark it off. So this point right here,
Breaker entry.
okay? That's gonna be your point of entry. Now stop loss, remember, this is all for 1 minute entry points. This is 1 minute entry patterns that go along with your analysis. So if you had a structure at this point, this whole structure is only going to be about, you know, 4 or 5 pips. It's not going to be that big. So that being said, if it's not going to be that big, you can just put your stop loss all the way up here. Maybe you'll have a stop loss of 5-6 pips. There's no problem with that. You could also put it above this point right here and say, you know, if price goes higher than this, I don't want to be in the trade. That's perfectly fine. I kind of leave it around this area, especially because it's, you know, it's such a small amount of pips. It doesn't make a huge, enormous, astounding difference, right? So I just leave it around that area. And then our target, of course, will be a lot larger in practice. But in this case, you know, just for the drawing, we put our take profit right at our target. But the important part to realize is this pattern right here, okay? And we will end up seeing a bullish perspective of this instead of a bearish perspective of this in just a moment, okay? Does everybody understand this?
Yes.
Yes, sir.
Okay, and
Yes,
it'll
sir.
look
Yes,
like
sir.
this. It'll look like this. Okay. Do you guys see how price takes liquidity right here?
Yes.
So price takes liquidity right here,
Yes, sir.
right? And now price goes lower. Now, what causes the movement downward that breaks structure? It's this,
Breaker.
right? So this right here is going to be the point that, you know, this is going to be the origin of orders that break structure right here. Okay. And then
Yeah,
what's
so
going
it's
to
the
happen?
breaker.
Price goes higher.
Come
Okay.
to the breaker.
Hold on. Let me explain it. Okay. So this is the origin of the orders. It goes lower, it breaks structure, and it takes the liquidity. Now after that, price goes higher. It breaks structure, right? That's the important part. It breaks structure. And now some of you will be saying, oh, well, why don't you sell from this order block, or why don't you sell from this? Okay, we're focused on the breaker block, right? That's what we want because we want to see a bullish entry. Our higher time frame analysis is bullish. So now it returns and we're focused on this area. So if we're focused on this area, this is going to be our original entry. Okay, where's your stop loss? Wherever you want it to be. It can be back here at the red line. It can be back here at the end of structure. But do you guys see what I meant by it's such a small stop loss that it doesn't make a difference? It doesn't make a huge difference, does it? Does that make sense to everybody? Okay.
Yes, sir.
Yes, sir.
And now what's our target? Our target was all the way up here, right? Because it was a higher time frame trade analysis. So it was all the way up here at the green line. And that gives you quite a bit of quite a good, you know, risk to reward. And from there, this happens all within a session, right? So this happened between 7:30 in the morning and 9:05. So at 9:05, you caught 30 pips and you ended up getting about 7% of your account. Pretty decent morning, right? Does that sound good?
Yes, sir.
All right. So, that is the breaker block. Okay. Very simple, very straightforward. Everybody understands. So everybody understands the mitigation block. Everybody understands the breaker block. Now we move on to the order block. Okay. And the order block is something that a lot of people have trouble with because they think everything's an order block. And this can be very frustrating to a student if they think everything's an order block and they keep losing. Okay. Now, an order block has a lot less requirements when it comes to 1 minute structure because it's 1 minute structure. You're not going to wait for an order block that was formed at, 3 a.m. and has no liquidity behind it and whatever. That's a lot, there's a lot less requirements here, but some rules still stand. And I'll show you which ones. Let's go lower. Okay. Now, the order block is going to be a little simple, but first, we do need to put some things out of the way. So firstly, These are going to be this is going to be my checklist. So for the order block, there should be no immediate liquidity behind the lower time frame order block. Should be in continuation of another move. And it should favor propulsion blocks rather than raw order blocks. Now, if you guys know what a propulsion block is, drop a 1 in the chat. If you guys know what a propulsion block is. If you don't know what a propulsion block is, drop a 2 in the chat. Okay, so I'll explain it very quickly just to get everybody on the same page. So firstly, let's draw an order block. Okay, let's draw an order block. Let's say that price has just taken liquidity from here, right? Price has just taken liquidity here, and we are on our way to a higher buy side target. Okay, this is what we're assuming. All right. So now let's draw price. Let's say price comes in, very simply takes this point, right? And now price kind of just breaks structure a little bit. And now here we see an order block. Now what's an order block? What does it look like? Well, very simply, it looks like this, okay? We're gonna change the colors very quickly. You know what we should do? We're gonna save this as a box. We're gonna put red, we're gonna put it all the way. This is going to be down candle. And now we're going to very quickly change it over to green. Okay. Sorry, I didn't know this was possible. So what we're gonna do, right, is let's say we're a down candle, okay? It's gonna look like a down candle. This is what it's supposed to look like. A down candle, and then immediately after, there should be an up candle. Okay. And usually it will engulf the other candle, okay? The previous candle. This does not mean that every single engulfing candle that you see on your chart is an order block, okay? Order blocks that are important should have taken liquidity beforehand. Okay, I should probably add that on here. Okay, now this is going to be essentially right here. Okay, what you're aiming for is going to be this rear candle. You will always target the candle that is opposite to the point that you're going. So if you have a bullish target, you're going to look for the last bearish candle, okay? And it'll come into the last bearish candle. Let's assume that this little red line is the top of the red candle. Obviously, it's not, but you know, whatever. You guys understand, okay? So let's assume that now we're touching the red candle, okay? And now price will take off from it. But usually on lower time frames, it doesn't just happen once. Sometimes it happens twice or 3 times, okay? So in my opinion on lower time frames, especially when it comes to order blocks, because they can be so finicky, I prefer propulsion blocks. And a propulsion block is a form of order block. Just how a mitigation block is a form of a breaker block, a propulsion block is a form of order block. And all that it really is an order block that forms when it mitigates another order block. And if we remember the definition of mitigation, mitigation is simply coming back or retracing into something, right? Especially on lower time frames. On higher time frames, there's a lot of theory, right? It's that, you know, orders are canceled out, blah, 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 blah. That's a little bit more in-depth explanation. But for this case, since it's very simple and it's on lower time frames, essentially it's when an order block is created when another order block is triggered. So let's say, so now when we come back down here, this order block was triggered, right? Now let's say this is the top of our order block or our propulsion block, right? The propulsion block is simply the second order block. Okay, it's simply the order block that was created when the first order block was mitigated. Okay, does that make sense to everybody? So it's the order block that results when another order block was already triggered. Okay, and it should look like this. Price hits a certain point, creates an order block is activated, right? Price moves, but when price moved, it also created its own order block. Okay, and since it created its own order block, now price can come back and do something like this.
Is
Let's
there
assume-
any requirement or it is necessary that the order block should be followed by the engulfing candle? Like in this case, the green candle.
So most of the time it is. Most of the time it will be. If it's not, then you're kind of looking for the smaller candle. But
Yeah.
generally, yes. Generally, the engulfing candle will be the next one. If the engulfing candle is the red one, take it with a little bit of caution or wait for your propulsion block.
And sometimes there are both are equal, like both the candles are equal, red and green.
That's
both are
fine.
equal.
That's fine.
That's fine.
Yeah, that's fine. That's fine. So if they're equal, that's fine. If the red one is engulfing the green one afterward, that is a little bit problematic. Just let it play out and probably get on the what's it called? Get on the on the propulsion block rather than the original order block. Okay.
And can you explain this should be in the continuation of another move? Can you explain that definition?
Yeah, 1 second. Let me finish explaining the propulsion block. It's the order block itself. Okay. So now very simply what will end up happening is price comes back down. Let's assume again that this red line is the top of this propulsion block. Price just takes this second order block and it runs with it. Okay. Now price will retrace back into it and it'll, do something like that. And then price will reach its target. Okay. Does that make sense? So now your entry will be on the propulsion block, either or, right? The order block is going to be a little bit more high risk. The propulsion block is low risk, right? So your entry point will be right at the, the red line, right? So if we were looking at the candles, it should be right here, right at the open or the wick. If it has any wick, use the wick, okay? Because it's on lower time frames of the down candle in this case, because you're going upward, right? If it was a bearish case, you'd use the green candle instead. Okay. So in this case, you put it right at the open. You put your stop loss at whatever wicks are here or whatever, at the end of these candles. And then you put your take profit at your target. Okay. Does that make sense?
Sure.
Okay. And I'm just going to draw an arrow from here to there. Does this make sense to everybody? Now I'll answer
Yes,
this
sir.
question. If there are no other questions, I'll answer the question about should be in continuation. Does anybody have any doubts, questions?
So what does it mean by immediate liquidity?
Immediate liquidity simply means this, right? Immediate liquidity is simply that there's like an obvious fair value gap behind it, or that there's like equal lows behind it, right? Essentially trying to what I'm trying to say is don't look at every single up down candle as a order block. Okay, does that make sense? Like, don't look at every single one of the moves that you're looking at and, oh, if you see an up down candle, you're gonna buy or sell from it, because a lot of the times there's going to be some liquidity behind it and you're going to be a little bit disappointed by what happens afterwards. So like, for example, some people may have said right here, this is an order block, right? Some people may have said this is an order block, right? Who would have said this is an order block?
Yes, I would have.
Right? So a lot of people would have said this is an order block. Can anybody tell me why it's not an order block?
It has not taken the liquidity. It has not taken the full liquidity. Probably.
So equal highs above and doesn't break the significant structure.
Well, the thing is, it actually did take significant structure, right? This right here actually did break significant structure. So a lot of people that have a very basic understanding of order blocks, they may have said, hey, this is an order block because it broke structure. But if we look a little bit closely, and some people may even have said, you know, this is an order block because it's in continuation. So this is a propulsion block. Well, firstly, even though they are correct, right? What's the problem? What's our higher time frame bias?
Bullish.
Right. The higher time frame bias is bullish, right? That's the higher time frame bias. However, one other thing that we should say is what's behind here? What's this?
Equal highs and fair value gaps.
MVP.
Right. So what ends up happening is right here, right? We actually end up seeing that. Let me just apply it a little lower. There we go. What we end up seeing is that there's buy side liquidity here. There's buy side liquidity. There's buy side liquidity. Right, all the way up here, here, right? There's a lot of buy side liquidity behind it. So if price just took liquidity and now price is forming a breaker, and you're like, oh no, price won't respect that breaker because there's an order block here. But remember that an order block gains its power from the orders that are inside of it. If there are no orders inside of it, and actually, as a matter of fact, there are orders against it, then what's the problem now? That this is just an engulfing candle. That's all it is. There's nothing to it. There's absolutely nothing to it because it has no power. It has no orders inside of it. Does that make sense?
Yes, sir.
And this immediate liquidity, what time frame basically we should? Any time frame, or we should look like a higher time frame also? Because now you are checking in 1 minute or 2 minutes or 5 minutes. Is there any criteria to check the immediate liquidity, like 1 hour, 2 hour?
Sorry, can you repeat that?
Is there any criteria to check the immediate liquidity like higher time frame also, 1 hour, 4 hour?
So I assume your question is more so like, does this happen also on higher time frames, right?
When basically, I just wanted to know, when we are checking the immediate liquidity, what time frame we should check?
1 minute. You should stay on the 1 minute. I'm saying, like, is there any liquidity close to it? There is. There's liquidity here. there's liquidity here, there's liquidity all the way up here, right? And if we look at this, the nearest liquidity is all the way across the world, right? And plus, our higher time frame bias has already stated that we want to go higher, right? We want to be bullish. So essentially, don't take a trade from here, right? Don't take a trade on lower time frames against your higher time frame bias. Does that make sense?
Yeah, it makes sense.
All right. So now I hope everybody understands how this is derived. If we were to look on, on the 1 minute, I'm sure you could find an entry somewhere. So like a very good example of this would be something like this, right? Again, this is not a perfect example, right? But all that I'm saying is like, this is what you kind of want to focus on. This is what you would want to look for. This right here. Okay, this right here. So essentially what would end up happening everywhere else is, let's ignore what's going on right here. What you would want to see is you would want to see price go higher, right? You would want to see price go higher from here and then return to this point and give you an entry. Okay, so you would want something like this. You can put your stop loss beneath the original order block since it's, it's so small of a stop loss, or you could put yours, behind the wick, and then you take profit at your target. Okay, this is what it should look like. Again, ignore the stuff before it. I'm just trying to find you a continuation example. Okay.
How to scan this? Like it's too demanding to check in 1 minute, then, or how to scan the charts? Like you have to go one by one, or all the pairs, or how to go about? We have to select only some pairs, like we will trade in minimum pairs.
Okay, so what you should be doing is you should be having higher time frame analysis. You shouldn't just be trading the 1 minute out of nowhere. Okay, you should be trading with higher time frame bias. So if there's higher time frame bias, then you should be, you should essentially have an idea of where price is going before it's even going in that direction. And then what you're going to do is you're going to want price to come to give you one of these lower time frame entries once you reach that point. So for example, let's say on this 4-hour USD CAD chart, we see that there's a liquidity void right here, right? And let's say price was down here. We know that price is going to need to come all the way up to fill in that fair value gap. Now we also see that there's sell side liquidity right here on both sides. So if there's sell side liquidity here on both sides, we understand that price is going to, well, not on both sides because of course it already happened, but in this case it's just one side, right? Well, we're going up there. So there's sell side liquidity here, which will translate later. So now we already have a higher time frame bias. So now when price comes in and fills this fair value gap and it starts turning on the lower time frames and it breaks structure, that's where we want to hop in and say, okay, I'm going to look for an entry. And what do we end up seeing? Actually, this is a very nice order block. Well, this is technically a breaker block, right? Because it did go up, break structure, it comes lower, and then it comes back to the origin, right? To the point where price originated the breakup structure. But this is a better example of an order block, right? So what happens is a little bit high risk of an entry, for my taste at least. You have your low right here. Again, the stop loss, as long as you have it somewhere decent, it's fine because it's such a small time frame that it doesn't quite matter. right? So it's here or here if you want it to be. I don't like putting it here, but you know, I'll put it like right there, let's say, right? And we understand that our entry is here because of the order block, right? So you get your entry, and then your target, of course, let's say your target's down here. Okay, great. You get this, you get this whole move, not out of hindsight, but rather because you had a lower time frame entry that you acted upon with a higher time frame bias. Now, this will take a lot of practice for you guys to get. Sometimes I miss these all the time, right? And you will lose sometimes, right? Sometimes you'll lose multiple times on a pair. There's a lot of people out there that say, oh, I can hit 1 to 100s like super easily. Okay, good for them. Ignore them. They're, you know, they're jokes in the community because they'll lose a million times just to win once and say, oh, I'm profitable. No, that's not how it works, right? If you want to risk more, if you want to wait for price to give you an even cleaner entry, that's fine. Develop your own taste for your own risks, okay? In this case, I'm just giving you a hindsight, because of course this is a hindsight example of what it would look like, okay? There are many more examples that I could go on and say, and, you know, claim, oh, I caught these, okay? But the one that I did catch is this one, which is a breaker block, okay? It's not an order block, but the theory is the exact same, okay? The theory is the same. Essentially, what you want to do is you look for these points in the market, right? When you're looking for an entry onto a move that you've already predicted on higher time frames, and you simply refine it on lower time frames and find your entries there. It's very common, right? And you can find really, really good entries on lower time frames the more that you practice. So does this kind of make sense? And by the way, I'm talking about this right here. This right there. Now, I really don't like order blocks in my experience in terms of lower time frames because they can be very misleading. So since I don't like order blocks as an entry point because they can be misleading, the ones that I prefer are breakers. Okay, those are the ones that I prefer. But you know, order blocks will still sometimes be a good entry. Though I would have preferred if this price created another order block and price retested that order block. That would have been a lot, you know, a lot better for me, if that makes sense.
And sir, is every inefficiency matters in the lower time frame?
No. And remember, I don't call them inefficiencies. So for me, inefficiencies don't really, you know, matter. What will matter is a fair value gap out of an entry, which I'll show you in just a little bit. Okay. And remember that when it comes to these structures, they shouldn't be spaced out. Okay. They shouldn't be spaced out over like a ton of candles, meaning like, you know, like you see something here, then you see something there, and then you take another entry, you know, across the world. No, you should be seeing them very close together. You should be seeing them knit together. These patterns will form very quickly and will be executed very quickly. Okay. There shouldn't be a ton of space between them. All right. So that's what I'm trying to say. Like you shouldn't think like, oh, this is your origin and this is the origin of your breaker and this is your break of structure, and now price will return to it and you have your entry all the way up here. Okay, that's just way too spaced out. You should have something more concrete, something like this. Okay, that's what I prefer. All right, that's why a lot of people, they show me their charts and they have like an order block that happened like half a year ago, and I'm like, why are you looking at that? You could have caught the buy all the way up to the order block if you wanted to, but instead you're focused on, you know, a piece of structure that probably isn't even relevant anymore. So look at your relevant structure around here. Okay. All right, so we have the order block, we have the breaker block, we have the mitigation block. We've already had our breaker, so we'll leave that here. The stop hunt BOS RTO is the exact same as the breaker block, so I'm going to leave that out. There should be no problem you discerning this, okay? And now we've moved on to our last one. Okay, this is our last one. Okay, there's the fair value gap entry. Does anybody know what a fair value gap entry is? Can anybody give me a guess?
So when the price is in continuation, then only we will look for buy or sell.
Right, but so I'm asking about a fair value gap though.
Normally 50% of the fair value gap entry.
Right, so normally there is a 50% of the fair value gap as an entry, right? That's what a lot of people use. So so a lot of people use fair value gaps as entries on higher time frames. I don't. The reason why I don't is very simple. I don't like messing with something that is supposed to be a price magnet, not something that should be, you know, I'd rather have an entry point from something that's meant to be an entry, not an entry point from something that's supposed to be a price magnet, to put it very simply. Okay, so a lot of other educators may suggest, okay, well, you know, take your point, take essentially your take your trade and take your entry from an inefficiency, and just to me, I don't, or you know, from whatever else they'll call it. I personally don't agree with that. I think, you know, those forms of those forms of entry just aren't valid in my opinion. So I don't like to take orders like that. So what I'm going to show you right now is the only type of time that I use a fair value gap as a type of entry, and it should help you get a little bit better of a bearing for you guys to kind of get a better entries. And let me show you guys what it is. I'm trying to find it. Okay, I'm looking at my notebook right now, so I can kind of see what day it was. It was on the 22nd. Here we go. New York time. Yeah, it was. Okay. Five-minute. Okay. And it's something like this. Now, for a lot of people, a lot of you guys might say, well, isn't this just a breaker block entry? And technically it is, but there's something here that I want to show you guys that's a little bit more than a breaker block entry, okay? It's a little bit different. Now, obviously here we can see a breaker block entry, and I'll show you exactly where it is, right? You have your liquidity right here. You have your breaker position. This is the point where your breaker originated. So your entry would have been here with a stop loss here, or hell, if you wanted to put it right here, you could have, right? And then your target, of course, being the high right here at least, right? Because, you know, your target, even though it was higher, you kind of wanted it to go wherever you wanted it to, okay? Now, let's look at this for a moment. Let's ignore, you know, the profit, everything like that. What is the point of this candle? And when I say this candle, I mean this candle. What's the point of this candle?
Take the liquidity out.
Right, to mitigate, right? The point is to mitigate, to retrace. So in this case, we see that price moves up explosively. And sometimes when price moves up explosively, it leaves gaps, okay? And the gaps that you're gonna see, by the way, you guys should already know the definition of a fair value gap, right? A fair value gap is a candle that does not have a wick covering it from one side or the other. So you see how this candle is covered? You know how it covers up to here, but there, you know, not the next candle doesn't. So this here is a fair value gap. Okay, that is a fair value gap right here. This is the fair value gap. Let me show it one more time. You guys see how there's no wick covering it up, and there's no wick covering it up here. Usually, they have to be when a move, when price moves too explosively, for price to come back down. It tries to, it doesn't. It doesn't do it. Right now, price comes back down very swiftly, and then comes all the way back up. Now, what happens here? In this case, you do have a fair value gap. So what you can do with the fair value gap entry is what you'll end up doing is the following. You will put your entry, okay, wherever you really want to. There's 2 points that you can put it, okay? You can put it at the entry, right here, and put your stop loss beneath structure. Oops. Here we go. And put your stop loss beneath structure. You can put it here, you can put it there, wherever you want. Okay, you can put it wherever you want. Or you can put your entry point at 50% of the fair value gap. Okay, here's your fib. You can measure out 50%. Boom, there you go. Okay, 50%. And then from there, you would just target your normal target, you know, like normal. Okay, you put your regular target like normal. But you take this lower time frame entry from this fair value gap so that you can get a more precise entry. Though you could have also gotten it from the breaker, this doesn't always happen. Sometimes when price is moving too fast, it doesn't come back to the breaker, but rather it pays attention to the fair value gap. And the fair value gap is the one that you want to take home, right? It is the one that you want to take. Okay, does that make sense?
Yes, sir.
Absolutely, yes.
Sir.
There
Yeah.
is also value gap on the upper green candle, right? Where the wick is there. The next candle is also there is a fair value gap.
Yeah, but when it's moving and when it's moving extremely quickly, right, especially on lower time frames, or when it's a candle that covers previous liquidity, meaning you see how there's a lot of buy side liquidity here, right? There's a lot of liquidity here. What ends up happening is these candles are actually covering or taking liquidity. When a candle covers or takes liquidity, it isn't exactly a fair value gap. In this case, you see that this is a fair value gap because it doesn't take anything. It doesn't cover anything. So that's a more valid fair value gap. But when price is expanding, especially on lower time frames, it's, you know, expanding like this. Those technically are fair value gaps, but we just consider them liquidity because it would be a pain to try to come back and take every single lower time frame point of liquidity that exists ever, you know? Does that make sense?
So, but
Yes.
it requires practice to train the eyes.
Yeah, I figured you guys would like a little bit more of a chart example rather than just a random example on paper. Does that make sense to everybody?
Yes, sir.
Yes, sir.
Alrighty. So yeah, I think so. That's essentially all of them. I'm not going to draw this one out because I already put like a live example of it. So I'm not going to draw it out. Essentially, this is your fair value gap entry right here. Right, you have your fair value gap right here. And remember that you can take it from either 50% or the open. It doesn't matter which one. And since you're on lower time frames, make sure that you do not set a limit, but you actually set it market execution and you actually take it market execution.
Can you show the order block chart where you draw the? I just want to take the screenshot.
No, which one? The order blocks one?
Yes, sir.
Here we go. So what we'll do is now we will take the screenshots that we need. So here's the order block one. Take your time.
Done, sir. Thanks.
Yeah. Okay. Next we have this one. So go ahead and take a screenshot. I can't share notes anymore, so I need you guys to take the screenshots here.
Okay, sir. Done. Thanks.
All right, and then there's mitigation blocks. Drop a 1 in the chat when you've already taken the screenshot. All right, I think the majority of people have already gotten it. All right, so yeah, these are entry patterns: mitigation block, breaker block, order block, and the fair value gap entry is right here. There we go. So take your screenshot of the fair value gap entry and drop a 1 in the chat when you've got it. Okay. All right. All right. So everybody should have these points in their. Oh yeah. Take an example of a breaker block. Hold on. Here you go. Take your screenshots. Okay. Here's your fair value gap example. And now here's your order block example. Take a screenshot of this.
I don't understand why we have to call this order block. Like, I don't see it taking any liquidity.
It's not taking liquidity. It's not meant to. Price has already taken liquidity beforehand, and then in continuation to the move it did. So this move here is the move that took liquidity. This move, okay? Now afterward, price creates an order block, and then price, once it broke structure, it returns and it becomes an entry point that you could get. Okay? It becomes an entry point that you can enter on in continuation to the actual move.
Okay, I understand now. Thank you.
Yeah. All right, guys. So yeah, I think that's going to be it for today. Next class is probably going to be some examples, some more in-depth examples. I'll do a little bit more digging into some more live examples. And next week, we'll probably do some live sessions together so that we can find them in real time. Okay. So thank you guys so much for watching. I think everybody has been a great student today. Thank you guys so much. If you guys could, spread the word to your teams about Empire, it would be great. That, every single person that we can get in their channel is a great help. For other people that are, wanting to learn, or wanting to learn more, I appreciate it. That's for people in the recording. And yeah, thank you guys for coming, and I'll see you guys next time. Okay.